Once a symbol of prosperity, China's housing market now faces its biggest test. With developers collapsing and millions of unfinished homes, is this the beginning of a crash or a path to recovery? China's housing market, once a towering symbol of economic success, now a story of empty cities, colossal debts, and a nation on the brink of financial uncertainty. But is this a crash beyond repair or a turning point towards recovery? By the end of this video, you'll understand everything there is about China's housing bubble and the Evergrande saga. Welcome to the untold story of China's housing market. Over the last 2 decades, China's housing market has shaped its economy and touched the lives of 1.4 billion people. It gave rise to a middle class, lifted millions out of poverty, and built entire cities overnight.
Every single person that moves from the countryside in China to a city needs to live in an apartment, and someone's got to build those apartments.
But today, developers like Evergrande are collapsing under billions in debt. Millions of homes sit unfinished, and entire neighborhoods remain empty. Is this the beginning of a crash or the start of a painful recovery? In this video, we'll dive deep into China's housing market crisis, starting with the collapse of Evergrande, the world's most indebted property developer with liabilities exceeding $305 billion.
If you just looked at the numbers, the amount of debt that Evergrande had, and you looked at how much money was on the books, you could tell there was going to be some trouble.
China's housing market has a unique phenomenon: ghost cities. Speculative building over the past 2 decades has resulted in 60 million unsold apartments. That's enough housing to accommodate the entire population of Italy. Yet these vast urban landscapes remain eerily lifeless, standing as monuments to overbuilding and unchecked growth. And we'll compare this crisis to the 2008 global financial meltdown in the United States. Are there parallels, and can China avoid the mistakes of the past? Stay with us as we uncover the roots of the crisis, its global implications, and whether China can save its housing market or if it's already too late. China's housing market isn't just about homes, it's the backbone of its economy. Real estate contributes nearly 29% to GDP, a staggering figure compared to other nations. From construction to steel manufacturing, the sector directly and indirectly employs over 50 million people. It's also tied to $60 trillion in household wealth, making it a lifeline for the Chinese middle class. But today, the cracks in the foundation are showing. Developers like Evergrande have defaulted on debts, leaving over 1.5 million pre-sold homes unfinished across China. Homebuyers who put their life savings into these homes are now protesting across the country, demanding answers.
If they don't give me back my money, I will have no choice but to jump into the river.
But this isn't just about individual homeowners, it's about confidence in China's economy. China's housing market has entered a crisis of trust. If confidence isn't restored, the ripple effects could destabilize not just the housing sector, but the entire Chinese economy. China's housing market wasn't always in crisis. In the early 2000s, as China's urban population exploded, the demand for housing grew at an unprecedented pace. Cities began expanding, transforming rural landscapes into dense urban hubs almost overnight. Between 2000 and 2020, its urban population rose from 36% to 61%. Driven by government policies promoting urbanization, developers raced to meet the growing demand. Between the years 2000 and 2020, over 400 million people moved to cities, creating a need for millions of new homes. developers like Evergrande, Country Garden, and Sunac became household names, promising modern apartments to a rising middle class. China's annual residential housing projects grew by 120% from the year 2000 to 2020, and over 250 million new urban housing units were built. To put this into perspective, as of July 2023, the total number of housing units in the United States was over 145 million. But this rapid expansion came with a catch: speculative financing. Developers, incentivized by rising prices, borrowed heavily to build more homes than the market needed, often in areas where demand was uncertain. By 2022, approximately 50 urban areas were classified as ghost cities, with developers borrowing heavily to build more homes than the market needed. This led to 65 million unoccupied apartments, creating vast neighborhoods like Kangbashi district in Ordos, filled with empty, unsold high-rises. The frenzy of speculative building wasn't limited to smaller developers. Even industry giants like Evergrande relied heavily on pre-sales to fuel their expansion. By 2021, 90% of Evergrande's projects were financed through pre-sales, a system where homebuyers paid upfront for properties that hadn't even been built yet. This created a fragile structure where cash flow depended entirely on the promise of future sales. Across the industry, developers collectively owed an astounding $5.6 trillion in liabilities by 2022, reflecting the massive risks embedded in this model. To tackle mounting financial risks, Beijing introduced the 3 red lines policy in 2020, setting precise thresholds to regulate developer debt. Developers that failed to meet these benchmarks, like Evergrande, found themselves cut off from critical funding, halting projects nationwide and exposing the fragility of their financial structures. Developers like Evergrande, already burdened with $305 billion in debt, suddenly found themselves unable to refinance their projects under Beijing's strict 3 red lines policy. With no fresh cash inflows, construction ground to a halt across China, leaving over 1.5 million pre-sold homes unfinished, valued at an estimated $230 billion. The sight of half-built towers scattered across cities eroded public trust in the housing market, fueling protests and setting the stage for the crisis that we witness today. The story of China's housing market today draws striking parallels to the 2008 financial crisis in the United States. At the center of the US crisis were subprime mortgages, risky loans given to borrowers with poor credit histories. By 2006, subprime loans accounted for a staggering 20% of total US mortgages, creating a ticking time bomb that would soon devastate the housing market and the global economy. Subprime mortgages, risky loans given to borrowers with poor credit histories, became a central driver of the 2008 financial crisis. By 2006, these loans had ballooned to a staggering $600 billion, up from just $160 billion in the year 2000, reflecting an unprecedented 6-fold growth in just 6 years. Banks bundled these loans into financial products called mortgage-backed securities and sold them globally. This system appeared profitable, but its foundation was dangerously unstable, relying entirely on a booming housing market to sustain itself. But by 2007, cracks in the system began to show. Housing prices, which had soared for years, stagnated and then fell, dropping by an astonishing 33% from their peak in 2006 to their trough in 2011. As home values plummeted, more than 10 million homeowners defaulted on their loans between the year 2007 and 2009, triggering a devastating domino effect. Banks and investment firms that held these risky mortgage-backed securities faced mounting losses with no clear way to recover. One of the most catastrophic moments of the 2008 financial crisis was the collapse of Lehman Brothers, a global financial institution that had heavily invested in risky mortgage-backed securities. On September 15, 2008, Lehman declared bankruptcy, erasing an unprecedented $600 billion in assets overnight. This marked the largest corporate failure in US history and sent shockwaves across global financial markets, leading to an estimated $1 trillion in global financial losses. As financial markets unraveled, the housing crisis spread across industries. Banks stopped lending, businesses cut jobs, and global trade slowed. By 2009, unemployment in the US had peaked at 10%, and GDP shrank by 4.3%, marking the worst economic downturn since the Great Depression. The scale of the 2008 financial crisis demanded swift and bold intervention. The US government launched the Troubled Asset Relief Program, or TARP, committing $700 billion to stabilize banks and prevent a complete collapse of the financial system. Meanwhile, central banks worldwide slashed interest rates to near zero levels and introduced quantitative easing. In 2009 alone, the Federal Reserve injected a staggering $1.25 trillion into the economy, purchasing mortgage-backed securities to restore liquidity and confidence. The aftermath of 2008 reshaped global finance, but the scars remain. Economists warn that over-reliance on speculative assets like mortgage-backed securities was a key driver of the collapse, and a lesson for other economies facing similar pressures today. China's housing market today bears some striking similarities to 2008. Speculative financing and over-leveraged companies like Evergrande echo these same warning signs. But there's a critical difference. China's government has far more control over its financial system. While the United States relied on market forces to rebuild after the 2008 financial crisis, China is taking a vastly different approach, leveraging state-directed policies to stabilize its housing market. Beijing has committed an extraordinary $1 trillion funding injection to support housing stability. Measures include converting unsold apartments, an estimated 60 million units at risk, into affordable housing. Construction is resuming on many unfinished projects, but the question remains: will these interventions be enough to prevent a larger collapse? The parallels between 2008 and China's current crisis remind us of the fragility of financial systems built on speculation. The real question isn't whether Beijing can intervene, but whether these measures will lead to long-term stability or merely delay an inevitable crash. The Rise of Evergrande is a remarkable story of ambition and vision. Founded in 1996 by Hui Kai-yan, a former steel factory worker, the company rode the wave of China's rapid urbanization. By focusing on delivering affordable housing to China's growing middle class, Evergrande quickly became a household name. By 2005, it had already completed over 30 housing projects across the country, laying the foundation for its future dominance in the real estate sector. Through aggressive pre-sales and rapid construction, Evergrande transformed itself into one of China's largest and most ambitious developers. By 2009, the company had gone public on the Hong Kong Stock Exchange, raising an impressive $722 million. Over the next 6 years, its assets soared from $80 billion in 2009 to an astounding $350 billion by 2015.
Hui is seen over the past 2 decades to have been particularly savvy about how he's expanded his business, aligning his investments and his growth and expansion into property alongside the agenda of authorities.
Evergrande also diversified its portfolio, venturing into electric vehicles, healthcare, and even sports, where its Guangzhou Evergrande Football Club became a symbol of its ambition. By 2021, Evergrande had accumulated an astonishing $305 billion in debt, earning the title of the world's most indebted property company. However, its rapid success was built on fragile foundations, an over-reliance on borrowed funds, speculative building projects, and an aggressive expansion into unrelated industries.
You can't keep on building property which is often unsold by using debt that property companies ultimately will not be able to repay.
This precarious strategy left Evergrande vulnerable as market conditions shifted. The beginning of the end for Evergrande came in 2020 when Beijing introduced its 3 red lines policy, a groundbreaking set of regulations designed to rein in the excessive borrowing that had fueled China's property boom.
Developers always had a way to take on more debt, which prompted the 3 red line policy.
In about August 2020, everyone was talking about the 3 red lines.
This policy imposed strict limits on 3 key financial ratios: a liabilities to assets ratio capped at 70%, a net debt to equity ratio limited to 100%, and a requirement for developers to maintain at least 1 yuan in cash for every yuan of short-term debt. For developers like Evergrande, this was a turning point. The implementation of the 3 red lines policy exposed the fragile financial practices of companies like Evergrande. With a liabilities to asset ratio of 85% in 2020, well above the 70% limit, Evergrande found itself unable to secure new funding. The company was forced to sell off assets and scale back projects, but its debt mountain, totaling $305 billion, proved insurmountable. By December 2021, Evergrande missed an $82.5 million bond interest payment, marking the start of its downward spiral. By 2021, Evergrande had halted construction on over 1.5 million pre-sold homes, leaving millions of homebuyers in limbo. These unfinished projects, valued at an estimated $230 billion, represented shattered dreams and life savings for countless families. Protests erupted across China as frustrated citizens gathered outside Evergrande offices demanding refunds or the completion of their long overdue homes. In response to the crisis, the Chinese government rolled out a 3-layer resolution framework to mitigate the fallout. The first layer targeted homebuyers by offering significant discounts on pre-sold homes, enabling buyers to finalize ownership without defaulting on their loans. For example, a home originally priced at $340,000 could now be secured for just $154,000, drastically reducing the financial burden. Within the first 3 days of implementation, over 610 buyers had already taken advantage of these discounts, signaling some relief in an otherwise dire situation. The second layer of the government's 3-layer resolution offered investors the option to receive finished properties or land instead of cash. This creative approach provided tangible value to those who had invested in halted projects. Meanwhile, the third layer focused on easing pressure on developers by rolling over large debts to 2027 and beyond, giving companies more time to recover and manage repayments. For smaller investors, this framework proved especially effective, allowing them to recover between 58% and 225% of their original investments. The collapse of Evergrande sent shockwaves through China's housing market, amplifying an already alarming oversupply problem. By 2024, the number of unsold apartments had soared to over 60 million units, a surplus so massive that it could house the entire population of Italy. These unoccupied homes are scattered across China, many in ghost cities like Ordos in Inner Mongolia, serving as a stark reminder of speculative overbuilding and market imbalances. Housing prices across China plummeted, leaving a profound impact on key cities. In Shenzhen, second-hand home prices fell by 7%, while Beijing saw even steeper declines of up to 12% by 2024. To revive the market, developers slashed prices on new homes to attract buyers, but consumer confidence remained stubbornly low. Many potential home buyers hesitated, worried about unfinished projects and a volatile market. Local governments, which depend heavily on land sales for revenue, found themselves grappling with severe fiscal shortfalls. In 2023 alone, revenue from land sales fell by 13%, leaving many cities unable to fund crucial infrastructure projects and public services. Across the country, delayed metro rail lines, halted public works, and reduced municipal budgets became glaring indicators of the deep strain on local finances. While government interventions have slowed the bleeding, analysts warn that systemic issues remain. The speculative practices that fueled Evergrande's rise and collapse continue to cast a long shadow over China's housing market and economy.
I think that there are real issues in China now, and they changed really in the last 4 years. And that is that they need a restructuring. A lot of the spending, let's say, individuals, 70% of their money was in real estate. Real estate has gone down. Stocks have gone down. Salaries have gone down. And so, and as a result, they're not spending and they're concerned and they're holding money in cash. At the same time, you have the government sector is a problem because most of the government spending, 83% of government spending, is spent by local governments. Those local governments got their money by selling land for real estate. Okay, there are no land sales, and they borrowed a lot of money, and those that they borrowed the money don't get paid. And so the question is, how are you going to get money into those places to operate?
China's real estate sector, once a cornerstone of its economic miracle, faced a significant contraction in 2022. Real estate investment plunged by 9.6% year over year, marking the sharpest decline in decades. Residential development also saw a steep drop of 9.3%, reflecting a broader slowdown in construction, sales, and overall market activity. These figures signaled a dramatic shift in a sector that once drove nearly 30% of China's GDP. This dramatic contraction coincided with Evergrande's spectacular $305 billion debt crisis, a figure that underscores the magnitude of the collapse.
The government is taking a particularly negative view on excessive leverage. Evergrande is the poster child for excessive leverage.
For perspective, Evergrande's liabilities are nearly half the size of China's annual defense budget, which stood at $230 billion in 2022. Remarkably, its debt even exceeds the GDP of nations like Portugal, which had a GDP of $300 billion in 2022. Such staggering numbers highlight the ripple effects of this crisis on the broader Chinese economy. To grasp the sheer magnitude of Evergrande's collapse, let's compare it to the 2008 US financial crisis. In 2008, the US government launched the Troubled Asset Relief Program, or TARP, committing $700 billion to stabilize the banking system. By contrast, Evergrande's debt alone stands at $305 billion, nearly half the size of TARP. Yet this staggering figure represents the liabilities of just one company, underscoring the scale of the crisis and its potential to impact the broader economy. China's oversupply problem adds a staggering layer of complexity to its housing crisis. As of 2023, an estimated 60 million apartments remain unsold, enough to house the entire population of Italy, which totals 59 million people. These empty units stand as stark reminders of years of speculative building and unchecked urban expansion, leaving vast stretches of ghost cities dotting the landscape. Meanwhile, housing prices continue to decline. In major cities like Shenzhen, second-hand home prices fell by 7% in 2023. In Beijing, the drop was even steeper at over 12%. This persistent downward trend has left many homeowners with properties worth less than their mortgages.
I'm upset and disappointed because we trusted this developer Evergrande. What's happening now is really heartbreaking. I'm just having a hard time turning around our lives because I'm paying so much money into it. It's bleak.
Taken together, these figures reveal a sobering reality: a housing market flooded with 60 million unsold apartments, burdened by $305 billion in Evergrande's debt, and reeling from a 9.6% contraction in real estate investment in 2022. These metrics paint a picture of a sector struggling under the weight of historic challenges, with ripple effects that are already being felt across China's broader economy. The impact of China's real estate crisis extends far beyond its own borders. As the world's largest consumer of raw materials, China accounts for a massive 54% of global steel consumption. However, as its housing sector slows, demand for steel, cement, and other commodities has plummeted, disrupting global supply chains. In 2022 alone, cement consumption in China dropped by 13%, leaving exporters from countries like Australia and Brazil grappling with reduced trade volumes and growing stockpiles. In Australia, iron ore prices, a key component in steelmaking, plummeted by 20% in 2022 as demand from China dropped. Brazil, another major exporter, saw similar declines in its iron ore shipments, raising concerns about the economic health of these resource-dependent nations. The ripple effects of China's housing crisis have reached energy markets as well. With fewer construction projects underway, demand for coal and natural gas, critical resources for building and manufacturing, have declined sharply. In 2022, China's coal consumption dropped by 6% year over year, a dramatic shift for a country that has long been the world's largest buyer of these resources. For global exporters, this decline represents a significant disruption to trade dynamics. Financial markets are also feeling the strain of China's real estate crisis. Developers like Evergrande and Country Garden collectively owe a staggering $220 billion to international bondholders. As these companies struggle to meet repayments, global investors spanning the US, Europe, and Asia are increasingly wary of exposure to China's embattled property sector, leading to widespread unease in global financial markets. The fallout is particularly concerning for emerging markets, many of which rely on trade with China. A prolonged slowdown in China's housing market could reduce global GDP growth by 0.5% annually, according to the IMF. China's housing market is no longer just a domestic issue, it's a global concern. From commodities to finance, the effects are being felt worldwide. The question is, how much longer can Beijing contain the fallout before the shockwaves spread further? In a bid to stabilize the struggling real estate market, the Chinese government announced a massive 1 trillion yuan stimulus package in 2024, equivalent to $138 billion. This package was designed to inject liquidity into developers and local governments, ensuring that halted projects could resume and unsold apartments could be repurposed into affordable housing. The scale of this intervention underscores the government's determination to prevent a broader economic fallout. One of the most significant measures in this package involved local governments stepping in to purchase unsold apartments directly from developers. With an estimated 60 million vacant apartments across the country, this strategy aims to convert these units into affordable housing, benefiting low-income families and urban migrants while simultaneously reducing the overwhelming inventory that has plagued the market. In addition, the government introduced a series of policy changes to restore consumer confidence. Mortgage rules were eased, with down payments for second home buyers reduced to just 15%. A significant drop from previous requirements of 25%. Interest rates on existing mortgages were also lowered, reducing financial strain on an estimated 50 million families and boosting disposable income across the country. Despite these efforts, the road to recovery remains uncertain. Analysts have highlighted that while these measures address some immediate concerns, deeper structural challenges such as oversupply and demographic shifts persist.
I see investing in China as largely a very attractively priced place that now has a lot of questions regarding the economic issues and the political issues regarding property rights and whether it's still glorious to be rich and how that'll work.
Local governments, heavily reliant on land sales, are also grappling with fiscal deficits, making long-term funding for these programs challenging. However, there are some bright spots. Second-hand home sales in major cities like Shenzhen have surged, hitting their highest levels in 3 years. In the first quarter of 2024 alone, over 2,390 second-hand homes were sold in Shenzhen, a promising sign of pent-up demand returning to the market. Yet analysts caution that these gains are uneven, with property prices remaining subdued across most regions, reflecting the broader challenges still at play. Yet, even as transactions rise, prices tell a different story. In Shenzhen, second-hand home prices have fallen by 7%, while in Beijing, the decline is even steeper at 12%. This mismatch between sales volume and pricing highlights the fragile nature of recovery as oversupply continues to weigh down the market. Analysts warn that these mixed signals could indicate a prolonged recovery period. While government interventions have helped stabilize some areas, the core issues, massive debt, oversupply, and dwindling population growth, pose long-term risks to the sector's health and to China's broader economic stability.
I think the problem is that the government thinks that there is an appropriate rate of economic growth, okay, and they think it's about 5. But 5% is probably faster than the Chinese economy can sustain without running into difficulties, whether it's to do with debt or to, just excessive growth in exports, which is in itself having negative feedback on a lot of other on pushback by other countries now as well.
Critics of China's interventions argue that these measures are little more than band-aid solutions, failing to address the deep systemic issues plaguing the real estate sector. At the heart of the problem lies China's over-reliance on real estate, which contributes nearly 29% of the country's GDP, far exceeding the global average of 15 to 18% in most advanced economies. This overdependence has left China vulnerable to any shocks in the property market, magnifying the crisis's impact on the broader economy. Another critical issue is the impact of demographic shifts on housing demand. With China's population aging rapidly and its birth rate hitting historic lows, demand for new homes is shrinking. By 2023, China's population had declined for the first time in over 6 decades, falling by 850,000 people in a single year. Analysts warn that this decline will further erode demand for housing, compounding the challenges of oversupply and unfinished projects. Adding to this is a massive inventory of 60 million unsold apartments, which reflects years of speculative overbuilding. Critics argue that simply converting these units into affordable housing, as proposed by the government, does little to address the root causes such as lax regulations and speculative financing, which led to this oversupply in the first place. Critics also warn that these measures fail to address the underlying structural weaknesses in China's financial system. Evergrande's collapse exposed the fragile web of debt that connects developers, local governments, and state-owned banks. With over $5.6 trillion in outstanding liabilities across the sector, many fear that without systemic reform, these interventions only delay an inevitable reckoning.
And actually, the government should just get out of the way and just do what everybody else does. Just allow the economy to do what it does, set your policies as you think they should be set, and just see what the growth rate happens to be at the end of the year.
On the other hand, supporters argue that these interventions are critical for buying time. By stabilizing the market, the government can shift focus towards structural reforms and the development of alternative industries to reduce economic reliance on housing. In fact, Beijing has already started redirecting investments toward emerging industries such as renewable energy, AI, and advanced manufacturing. In 2023 alone, the Chinese government allocated $240 billion for green energy initiatives, a move seen as pivotal for reducing the economy's dependence on the real estate sector. Supporters believe this shift towards a diversified economy could provide long-term stability. By reducing reliance on real estate, China can avoid repeating past mistakes while building a fountain for sustainable growth. Still, only time will reveal whether these measures mark the beginning of recovery or merely postpone a more significant economic crisis. While Evergrande's crisis underscores significant structural challenges, the term crash may overstate the situation. The government's 3-layer resolution framework and targeted interventions have averted total collapse. However, systemic issues like oversupply, declining confidence, and demographic shifts require long-term reforms. The current state reflects a controlled correction rather than an uncontrolled crash. As Beijing shifts its economy away from over-reliance on real estate, the next decade will test its ability to manage both growth and stability. What do you think? Has China's housing market been saved, or is this a crash merely postponed? Can the government's ambitious interventions succeed in balancing short-term recovery with long-term reform? Let us know your thoughts in the comments below, and don't forget to like and subscribe for more in-depth analyses of the world's most pressing issues.